So in Chapter 12, we were starting to look at, consider life insurance, on with the insurance mode. Remember, again, as I said before, these are all financial instruments that are out there to either to protect income, protect wealth, protect your, your overall wealth, your assets, your financial interests. That's the idea with insurance. It's a setup that's designed to for protection, for protective purposes, if you will, to protect your assets from being taken away. Whether we're talking about health insurance or if we're looking at auto insurance, homeowners insurance, etc. It's protect your assets. The difference with life insurance, of course, is that it's protecting your assets, but it's also doing what? It's protecting your financial interest, the financial interest for your family, right? So this goes beyond yourself, meaning, of course, that it protects, it indemnifies, it protects your family in the event of your demise. We'll leave it at that. So this is kind of the difference, if you will, with life insurance. There are others that go along with that as well: accidental death and dismemberment rather. Different types of insurance that are along the same lines. But anyways, define life insurance and describe its purpose and principle. Determine your life insurance needs. Just as it is, you don't want to have $1 million worth of insurance on a $150,000 home. You also have to be cautious with your life insurance. You don't want to be overinsured or underinsured for that matter, but typically people go overboard on life insurance, and it becomes a very costly endeavor going forward, costly expense. Anyways, we'll get into that as we go through it. Distinguishing between the types of life insurance companies, analyze the various types of life insurance policies, and they are innumerable. Select important provisions in life insurance contracts. Create a plan to buy that life insurance that we just described, and evaluate the payout options for life insurance. Remember, it's not for you, it is for your beneficiaries, right? Keep that in mind for the most part anyway, and we'll get into that as we go forward. So defining life insurance and describe its purpose and principle. Life insurance, as with all other types of insurance, a person purchases a policy by paying a premium, and the insurance company promises to pay a sum of money at the time of the policyholder's death to the designated beneficiary or beneficiaries. If an endowment, then the amount paid is paid to the policyholder while living, meaning this would be like a whole life policy, and we'll get into the distinctions as we go forward. Purposes of life insurance: protect someone who depends on you from financial loss related to your death. Again, this is not for you, because it's for for the folks that you leave behind, for your beneficiaries, right? Proceeds may also be used to pay off home mortgage, other debts at the time of death. Provide lump sum payments to children when they reach a specified age. That would be an endowment. Provide an education or income for children. Cover medical expenses and funeral costs, accumulate savings, or establish income for survivors, make estate and death tax payments. There are all kinds of policies out there that you can that are they're not one size fits all. In other words, they can modify policies and so on and so forth. It's very, very typical. Anyhow, so the principle of life insurance and life expectancy, the principle of life insurance, as with all insurance, focus on actuarial information, mortality tables, showing the number of deaths among various age groups and gender during any given year, the likelihood that you are going to you take out a policy when you're at age 50 for 20 years. What is the likelihood of you surviving a term life policy, for example, that expires after 20 years? What is the likelihood that you will die before those 20 years? The good news is that you may end up paying premiums and get nothing in return for a term life policy, for example. But the good news is that you're around to see that life insurance policy expire when you're at age 70. Anyway, life expectancy, individuals are living longer due to that that improved and costly Medicare coverage that we had taught, medical care rather, healthier lifestyle hopefully, and education. People are educated, have a tendency to live a bit longer, just as a, again, general rule of thumb, because the jobs that they are employed at are probably less physically demanding, and so on and so forth. And this is the bonus for women. They tend to live quite a bit longer than men on average. I'm thinking at least 5 or 6 years, and I'm probably underselling that. But the point again is that women on average tend to live quite a bit longer than men. Determining your life insurance needs. This is always a tough part. You have people you need to protect financially, a spouse, children, parents, anybody, any other dependents that you can, if you have extended family, if you have nieces and nephews that you foresee yourself having to take care of, siblings, etc. This is the whole idea behind insurance, and setting it up that way. So it's influenced by your stage in the life cycle. Remember, in life cycle, we're talking about when you're young, you don't think about these things. And then when you reach a certain age, you start to contemplate, think about these things. And then when you're in the later stages of your life, when you're older, you're looking at life from a different angle, if you will. One, you don't have as long of an outlook. Two, you are considering more about the people that you leave behind, the ones that are dependent upon you, so on and so forth. So it's influenced again by the stage of where you're at in the life cycle and the type of household in which you live. Households with small children have the greatest need for life insurance. If a spouse, a working spouse, dies and is the main breadwinner, whoever that is, or typically both are working, and you need both incomes, so you've got to make up for that income that's missing, is really what it is. So there tends to be more of an urgency, if you will, for life insurance to cover the needs of younger couples or younger people in general, and especially if they have children. So determining your life insurance objectives: how much money do you want to leave to your dependents if you were to die today? That's as blunt as you could put it. Will you require more or less insurance protection to meet their needs as time goes on? And there are formulas and so on and so forth that could be employed. When would you like to be able to retire? Another thing to consider, meaning again that you have insurance set up so that, we'll just use an example. You'd like to retire when you're 60 years of age. You would also like to have $300,000 worth of assets upon which to live, in addition to your Social Security and so on and so forth. But you reach the age of 50 and you have $5,000 saved. For whatever reason, there's no way you're going to hit that $300,000 mark by the age of 60. So it would behoove you that if you do want to retire at age 60, to have a life insurance policy to provide for that income stream for your loved ones after again you meet your demise, if you will. So it could be helpful in terms of determining whether or not you want to retire. All these things we're looking at the entire picture, your entire financial picture. What amount of income do you believe you and your spouse would need in retirement? Would you like to spend your retirement savings? And know that again you have some an insurance policy that's outstanding, on which you can fall back on for your spouse, for your significant others, for your dependents, for those your beneficiaries, something to leave behind for them. So keep that in mind. How much are you able to pay for your insurance program? as is the case with the long-term care insurance and pretty much any other type of insurance, ADD, accidental death and dismemberment, all the different types of life insurance policies. When you're younger, they are less expensive in terms of premiums, but the downside, of course, is that you have less. You would have less money, financial wherewithal for consumption, for current consumption. You'd have to put that off. So, but again, the good news is that you would be paying lower premiums. So this is the trade-off, if you will. The opportunity cost is high for insurance, but it's something. This is why you have to consider what your insurance needs really truly are. And it all comes back down to how much you're able to pay for that insurance program as well. How much are you willing to surrender to give up for that insurance policy? Are the demands in your family budget for other living expenses likely to be greater or lower as time goes on? It's the easy answer, of course, is that it's always going to be more. However, this is again when we start thinking about things in terms of your cost of retirement, the different income streams that you would have, your Social Security, if you have a pension, defined pension, if you have savings, how much you would be taking out of your savings, if you will, to live on as you go forward. Is your home, you're planning on having your home paid off at a certain age, so on and so forth. All those things can come into play. Anyway, estimating again your life insurance requirements. The multiple of income method needs range between 5 and 8 times of your you need in general. The needs range between 5 and 8 times your annual income. So if your income is $50,000 a year, anywhere from $250,000, what did I say? $50,000 to $250,000 to $400,000 of a life insurance policy. The easy method, typical family needs 70% of your salary for 7 years before they adjust to life without your income. Back to that $50,000 income, 50,000 times 7 is 350, so $350,000 policy. Easy method, simple, straightforward. 70% of your salary for 7 years. The dual income, the DINK or method, or the dual income no kids method, it's your funeral expenses. Your funeral expenses plus half of your outstanding debts. So funeral expenses, we'll just say a number of, say it's $10,000, just say $20,000. You want to have a nice funeral, nice send-off, if you will. So your funeral expenses plus you owe, we'll just say $100,000 on your home, and another $20,000 on cars. So that's $120,000 in toto. So that's we're looking at $60,000. I think that's what we came up with anyway. 55,000, we'll say 60,000 plus the other 20,000. So we're looking at $80,000. So these are just some things that you have to consider. These are different methods that you can use. These are all just rules of thumb. Whether we're talking about the multiple income method, the easy method, the 70% of your salary times 7 years, or DINK, the dual income, no kids. So it's just yourself and your spouse, for example, or your beneficiary, and you want to cover your health, your funeral expenses, and plus half of the outstanding debts, meaning that your significant other would be paying the other half of those debts that are left behind. Estimating again your needs, the non-working spouse method, multiply the number of years until the youngest child reaches 18 by $10,000. So we're looking at annual expense of a child of $10,000. So if the child is let's just say 8 years of age, so they have 10 more years until they turn 18, and you've got twins. I should say one child is $10,000 times 10 years, $100,000, and you happen to have twins, so that's $20,000. The family need method, more thorough because it also considers employer-provided insurance, Social Security benefits, liquid assets, so on and so forth. You take a lot of different factors into play. There are tons of online calculators and apps that are out there that are available for you to estimate your life insurance needs. It's very straightforward. And there are reasons for life insurance, by the way, back to that life cycle that we had talked about. There are reasons for young people, obviously, to have life insurance. There's reasons for people that are a bit older to have life insurance, and even reasons that people that are quite old to have life insurance. And anyways, these are all things that you can rationally go through and consider. So type of life insurance companies distinguish between the different types of insurance companies that and how they why they exist, how they're comprised, so on and so forth. So stock life insurance companies are owned by shareholders. 71% are of this type. So most insurance companies are stockholder, meaning that their shareholders are the owners, if you will, of that insurance company. They sell non-participating policies. If you want to pay the same premium each year, choose a non-participating policy with its guaranteed premiums. Okay, so this is a set piece where there are not going to be adjustments based on such things as inflation and so on and so forth, right? Mutual insurance companies, so we have shareholder or stockholder companies, 70%, and we also have what are called mutual life insurance companies, 29%. So the remainder of the life insurance companies out there are Mutual of Omaha type of companies, insurance companies. Those are owned by the policy holders, and they sell participating policies. So the higher premiums they tend to have higher premiums than non-participating policies, but part of the premium is refunded to the policy holder annually. It's sort of a dividend, if you will. The refund, again, is called the policy dividend, excuse me. And so these are mutuals. These are, they're owned by the people that are, it's like a cooperative. The people that actually have insurance own the company itself. Types of life insurance policies, temporary insurance, term, renewable, term, convertible term, or decreasing term insurance. This is these again are temporary for your needs to cover a certain period of time period. Permanent insurance, also called whole life, straight life, ordinary life, or cash value life insurance. And we'll get into the breakdown. So term life insurance is used to protect for a specified period of time. If you stop paying your premium, the coverage stops. There's always a renewability option, and it may or may not be a guaranteed renewability option, but renewing the policy at the end of the term without a medical reevaluation, that's the guaranteed piece. Multi-year level term, popular because you pay the same premium for the life of the policy. So it's kind of, again, that budget plan, if you will. Conversion option. You can exchange term policy for whole life policy without a medical examination. Decreasing term insurance premium stays the same, but the coverage decreases as you age or the debt is repaid if paired with the mortgage, for example. Return of premium. This policy refunds every penny the premium paid if one outlives the policy terms. And this last one is of course the one you would like to have, because that way you can have your cake and eat it too. You get your premiums back if you live through the end of the policy. Anyway, those are expensive. Anyhow, those are term. The next we're looking at our whole life. Whole life can get extremely complicated. It's pretty straightforward, but it can be pretty complicated. This is a permanent life insurance, if you will. It's also called straight life, cash value, or ordinary life. You pay a specified premium as long as you live. Premium depends on your age. When you start the policy, provides death benefits and a savings account. It accumulates a cash value, is what we're saying. Makes sense if you intend to keep the policy for long term or must be forced to save. First, consider other savings and investment options before investing in a whole life policy. Limited payment policy, pay premiums for a stipulated period, usually, again, think about mortgages. You're paying for 20 or 30 years or until you reach a specified age. Your policy then becomes paid up and you remain insured for life. The face amount paid of that policy at the time of your demise. Once again, this member insurance is set up primarily for whom? For beneficiaries at the end of when you die. So modified life insurance policy, attractive people who want whole life policies but find premiums too high to handle on their current budget. So they would be staggered over a period of time, lower payments up front, then higher payments as you go forward. Again, typically allow lower premiums for 5 or 10 years, and the premiums increase significantly for the remainder of the life of the insured. Variable life policy, minimum death benefit guaranteed, but cash value is not guaranteed. The death benefit can be greater than the minimum depending upon the earnings of the dollars invested in a separate stock, money market, or bond fund. So all these different variants on whole life insurance. Adjustable life insurance policy. It's a whole life insurance policy, but you can change your coverage by changing the premium payments or the period of coverage. So you can alter things, if you will, as you're going forward. Universal life gives you more direct control. You can pay premiums at any time and almost any amount. The amount of insurance can be changed more easily than traditional policy. Remember, the more flexibility that you have when you buy insurance, the lower the payout is. Keep that in mind too. The more restrictive that part can be. So anyway, whole life insurance, again, to wrap it up, the increase in the cash value of the policy reflects the interest earned on short-term investments. So what we mean by short-term investments, the whole idea of interest, remember, the shorter the vehicle that's used, the shorter the term of the vehicle that's used, the lower the interest rate. Remember the time value of money that we talked about earlier. So these are all short-term investments, if you will. So it combines term insurance and various investment elements, if you will. So typically group life insurance is what we're talking about, is life insurance that you secure through your employer. And this is great. Typically it's much lower the cost for group life insurance, but if you happen to leave the company, you typically, I think in most cases, you have the option to buy a single policy, if you will, or how should I put it, an individual policy, but the cost typically goes up again quite significantly because it changes over from that group policy status to the individual. Anyway, so it is term insurance unless otherwise stipulated. So endowment life insurance provides coverage from the beginning of the contract to maturity, and guarantees payment of a specified sum to the insured, even if it's still living at the end of the endowment period. So if you've got a 20-year policy and you survive the 20-year window, if you will, after that you do receive some payment. This is endowed life insurance or endowment life insurance, if you will. Credit life insurance used to repay personal debt such as car loan if borrower dies. It's an expensive protection, and as it says here, it's considered kind of a ripoff. It's sometimes you can get these through credit unions, and it's not terribly expensive, but typically it's something to kind of be very leery of and to shy away from if you can. Industrial life insurance, known as home service or debt insurance, premiums collected at insured homes, and these are very typical home warranties and that type of a thing, if you will. Home service or debit insurance, premiums collected at insured's home. Anyway, it's not very popular. I don't really know much about it. I don't know anybody that has it, so we'll leave it at that. So important provisions in life insurance contracts, things to make note of. Again, we're really drilling down on these things, so you have to pay very close attention as you read through this. If not fine print, then at least get an understanding of what these policies are all about. They typically have summaries. Read the summary for sure, and if you have any questions about anything that's in the summary that doesn't make sense, you can drill into the actual contract itself and read that portion. Anyway, payments to life insurance policies, policy reinstatement of a lapsed policy that has not been turned in for cash, time limit of 1 to 2 years. Grace period allows 28 to 31 day late payment without penalty. Automatic premium loan, cash value is used to pay premium if not paid within the grace period. Guaranteed insurability option. These are all items as you go through. Clauses in life insurance policies, non-forfeiture clauses. These are important. Keep accrued benefits if you drop the policy itself. So you have some cash value, if you will, even if you drop the policy. Incontestability clause, after the policy has been in force for a while, let's say 2 years, the company cannot dispute its validity for any reasons, including fraud. Suicide clause during the first 2 years. Sad but true, people take out insurance and they off themselves. I shouldn't be so blunt about it, but this is why we have such things as suicide clauses and so on and so forth. It's to protect against that eventuality. Paying life insurance policies, naming your beneficiary, contingent beneficiary in the event of you and your spouse are driving and both of you die in the same accident. Shouldn't say those things again, but you have to have someone as a backup, if you will, a backup contingent beneficiary. Misstatement of age provision pays based on your actual age, whatever. So this is, people lie about everything, honestly. And so if you were to pass away, then your age would, it's something that would be determined based upon birth certificates and so on and so forth. At any rate, policy loan provision to borrow against the cash value up to the cash value of the policy itself. Joint life options, first to die pays benefit upon death of first spouse. Second to die also called survivorship life insures 2 lives. So these are just different features, if you will, of life insurance policies. Pretty straightforward things. A rider to a policy modifies the coverage by adding or excluding conditions or altering benefits. Riders typically are adding, not taking away, but adding. At any rate, a waiver of premium disability benefit, accidental death benefit, double indemnity. Meaning again that if you die if there's an accident associated with your death, then it would pay off double, right? Cost of living protection, which that has to do with inflation. Inflation increases typically year over year. How much? Who knows? At the moment, it's pretty low, but could your $300,000 policy today is going to be worth less in real terms in 20 years from now, for example. But if you have cost of living protection, it would go up accordingly over that 20-year period or whatever the time period is. Accelerated benefits, also called living benefits, pay to those who are terminally ill before they die. Again, this is unfortunate, but in the event of your demise, if they're you're given you have some disease in which you've got a set amount of time, 6 weeks, 6 months, a year, probably a year or less, I'm guessing. They would start to pay some of your benefits up front before you die, so that you can do 2 things: enjoy a little bit, hopefully, and to set your financial affairs in order, and also to pay for things, because it's an expensive proposition. I hate to put it that way, but it's very, very true. So creating your plan to buy that life insurance. From whom do you buy insurance? Again, insurance is regulated by the state, whether you're talking about the state of Michigan or New York or California or whatever. Typically, insurance is heavily regulated within by these state authorities. Sources involved examine both private and public sources, rating insurance companies. Rating through AM Best is typical. This is the AM Best is a ratings company, and they rate um, insurance policies, or insurance companies rather. Check reputations of local agencies and talk to friends or colleagues. See who they have and why they have who they have. If they know, if they don't know, then you keep looking anyway. But keep that in mind. So choosing your your insurance agent, fun stuff. Can friends or parents make recommendations? Absolutely. Does the agent have professional designations such as Chartered Life Underwriter, CLU? And the more certifications, the better off you are. I'll just say that in simple terms. Is the agent willing to find a policy that's right for you, or does he or she push a certain type of policy? If they're working for, who are they working for? Are they working for you or a specific insurance company or a group of insurance companies? You want to find somebody who's going to be looking out for your best interest. It's not always easy to figure that out. Do they ask you about your financial plan? This is a double-edged sword, because typically when you're talking about, they want to know more of your financial situation so that they can determine what insurance is right for you. But oftentimes they're also very curious to see what your portfolio looks like for their own purposes, what they're going to sell you, and just think these are salespeople too. If you feel pressured at all, just don't. Remember, always sleep on these decisions. Is agent available when you need and happy to answer questions? Walk away from the table, and then come back and talk to that agent, right? 5 factors affect the price of a policy. This is good stuff here. The company's cost of doing business, the return on the company's investments, mortality rate the company expects among policyholders, policy features, competition among companies with comparable policies. The reason these are important, especially when you consider like the mortality rate the company expects among policyholders. If the expectation is that if the policies that they have sold are to older people, then they will be paying out a lot in terms of policies going forward. And the problem with that, it's pretty straightforward, it's easy to understand, is the company have enough liquidity? Does the company have enough funds to absorb those losses, frankly? Underwriting. So underwriting uses many attributes of individuals such as age, gender, health. This is like when you're talking about underwriting, they're looking at the bigger picture, and then drilling down on the individual. Many attributes of the individual such as age, gender, health, occupation, even hobbies, to determine the appropriate premiums to charge for insurance. Trying to figure out what sort of a risk you are is really what it comes down to. It's funny, but it kind of does come down in that order. Typically age, how old you are, gender, of course. Females tend to live longer than males. Health, if you have underlying chronic health issues, if you're a diabetic, or if you have heart conditions, if you have a history of heart conditions in your family. Occupations, if you're what is it? The folks that are out there, the crab fishermen and off the coast of Alaska. It's a deadly job, right? Anyway, you get the idea. All these things are kind of taken into account when we're talking about from the underwriter's perspective, trying to determine what your risk status is. Using interest-adjusted index to compare, it's up to you, interest-adjusted index to compare policies. What that is, you take into account the time value of money. It helps to make cost comparisons among insurance companies. And the idea is that the lower the index, the lower the policy cost. Straightforward as that. So again, these are all things that you can gather online. It's out there available for you. So obtaining and examining a policy, you get your application, provide your medical history, and detail. This is remember now, when we're talking about life insurance, when you're borrowing a home, they want to know all of your credit history, your credit life, if you will. And when you're trying to get a health, and if you're trying to get life insurance, rather, they want to look at your health, where you're at, age, and all the other items that we had talked about before. So that's why they ask for your medical history. Usually no physical for a group policy. So if you're buying it through your employer, there usually is no physical, but you never know. Read every word of the contract, and this is very important. It could be the contract itself could be 10, 20 pages long, and you just have to take your time and go through it and ask questions if they will come up. Make note of those questions. After you buy it, you have a 10-day free look period to change your mind. Typically, when we talk about it's called the right of rescission, it's 72 hours, but insurance, because it's such an important step, and you're stuck with this. If not stuck with it, you're making a very long-term commitment. They give you a 10-day. There's a 10-day required free look period in which you can change your mind. Photocopy this and keep copies. This is one thing, back to when we talked before about if you have a safety deposit box or a safe in the house or whatnot, you definitely want to keep a copy of your insurance policy, of your life insurance policy. Very important. After the purchase, after you buy new life insurance, you have a 10-day free look period again. When you receive your new policy, read it carefully. If you are not satisfied for any reason, you may return that new policy within 10 days after you receive it, mail it to the company's home office, or give it back to the agent who sold it to you in the first place. No one does this. They should not send it back, but should go over it after they actually receive the policy. It's something very important. So be sure to get a dated receipt from the post office or the agent. If you are returning, the company must return your premium within 30 days from the date you return the policy. If the insurance company keeps your money longer, legally is responsible for 10% penalty payable directly to you, if you will. So evaluating the payout options for life insurance. So we have the death or survivor benefits. To cover the immediate expenses resulting from the death of the insured, to protect dependents against the loss of income resulting from premature death of the primary wage earner. Again, these are all the payout options that are associated with this. Lump sum payment pays the face amount in one installment, proceeds left with the company, pays interest to the beneficiary. Limited installment payment pays equal installments for a specific number of years after your death. Life income option, payments to the beneficiary for life. In this case, it would be an annuity payment over the life of the beneficiary, if you will. So it's insured of a whole life policy. Rather, it may borrow against the cash value or surrender policy and receive cash value. So again, this is whole life. Whole life is it's a different kind of a vehicle than term life. Term life policy is that you're just paying in. It's a temporary situation, whereas a whole life is just that. It covers your whole life, and it's very attractive. But the problem, of course, is they can be very, very pricey. People who purchase variable life insurance policy may supplement retirement income by withdrawing some of the investment portion as an annuity. So these are their conversions or convertibility, if you will, with a lot of life insurance policies. An annuity is again, it's a payment, regular payments over a period of time, if you will. So, are you still insurable? Before you switch, make sure you are still insurable. Check medical and other requirements. So, if you're paying into you're 5 years into an insurance, in a 20-year window insurance policy, and you don't like it, but the problem is that you were diagnosed recently with some chronic illness, you have a heart murmur or something, or some other, back to what I said before about diabetes is a very typical one, and that alters your insurability going forward. So you really have to be careful before you decide to switch policies. And again, this is, as I said before, the older you are, the higher the premium will be. So if you were to get insurance at age 30 versus age 60, the monthly cost of the premiums for the same type of insurance could be as much as 10 times more at age 60 than at age 30. It's just the reality. It all comes down to math, the actuarial tables, the mortality tables, and so on and so forth. Can you get all the provisions in the new policy that existed in the old policy? Good luck again with that. So these are all things to consider. So insurance, life insurance in this case we're talking about, you have to spend a good deal, significant amount of time doing your homework. This is a financial instrument with which you get to live with going forward. So not to be scared of these things or not to be dismissive of them, but they are important things that you do have to get your head wrapped around, okay?